Very sorry, sir, got disconnected. Good evening, members.
It happens, don't worry, cool.
Good evening, members. It's my pleasure to welcome CA Jomon K. George, sir, past chairman of SIRC of ICAI, a very vibrant person and very vibrant on the topic also. He's supposed to be a specialist in corporate audit and compliances. So he's here with us today to educate us on the main changes and other important things to be considered during the audit. Thank you very much, sir, for accepting our invitation. And special thanks for accepting our invitation to do the session without CPE due to unavoidable circumstances. And sure, we hope to have you physically for a CPE meeting, sir. So,
my pleasure. Anytime.
Secretary CA Venkatesh, sir, to introduce the speaker formally.
Thank you.
Good evening to one and all. It's great pleasure for me to introduce our today's speaker, who is going to handle the session on Corporate Audit 2021-22. All you need to know. CA Jomon K. George is the fellow member of the Institute of Chartered Accountants of India and having more than 30 years of diversified practice experience. Chairman of Southern India Regional Council of India during the year 2019-20. He is a founder and managing partner of leading firm in India, consists of 8 partners, and he mainly specializes in corporate audit and consultancy. His mentor, Philip Macmillan Woods, a multidisciplinary accounting and consulting firm based in Dubai. He is faculty for auditing at ICAI and taught more than 10,000 CA students. He is regular resource person on professional circuit on accounting and auditing standards and corporate audit and has done more than 900 presentations. He is also a peer review trainer. He was member of the Auditing and Assurance Standards Board of ICAI. He was chairman of ICAI Ernakulam in the year 2002-2003. He was past president of Rotary Cochin Central and a member of various social clubs. He is Honorable Treasurer, Regional Sports Center, Kochi. He is the member Advisory Board, Saint Teresa College, Ernakulam. He also authored a book, Trials, Pin Padakal, Reflection of Personal and Professional Life, released in the year February 2021. With his few words, I introduce CA Jomon K. George, sir, before this virtual forum. Now the session is yours, sir. Thank you.
Thank you so much for the nice introduction. Chairperson of the Madurai branch, Manimekalai Madam, Secretary Venkatesh sir, other managing committee members, some of our yet to join, members who are online with us for this evening program, the CP program on company audit 21-22, all you need to know. Warm good evening to all of you. I'm extremely happy to be with you virtually though to do this presentation. As a chairperson wished and wanted, I'm only happy to come down to Madurai at any time. As COVID is gone now, Kerala, we are a little careless now. I don't know what's the situation there. Mask is all gone now. And therefore, I think it is high time that we started physical meetings. Cochin, we are having a lot of physical meetings, but people are a little reluctant to come in large numbers for physical programs. I'm also seeing a good number of past chairman, Jaishilan sir, a very dear friend and patron. I would also like to recollect the good times I have had with the patronage of PVR, Rajarajan sir. I was Sikasa chairman when he was chairman of the region. And of course, DC was there when Madam called me for this program. I heard somebody in the background talking and then I could make out it is DC because he's very loud all the time. And so both of them I remember and they were a good time in SIRC. He was more like, PVR was more like a guide and a senior colleague in the council. DC, of course, when I was chairman, he was vice chairman and went on to become chairman. But he was a virtual chairman. I was a fortunate chairman. somebody in lighter vein said I was the last physical chairman. Because I laid on office in end of February 2020. DC took over, and then by March 15th, the pandemic had struck, and then it stressed us, and we also had a wonderful conference, though online. We all attended that online. So once again, good evening to all of you. Expecting more members to join. We will get the session started. The topic, as Secretary and Chairperson rightly said, is corporate audit. All you need to know. With that, let me try to share my screen. Madam, you are muted. Can somebody respond? Is the screen full screen visible?
Yes, sir. Yes, sir.
Visible. I can go ahead. Okay, fine.
Yes. Yes.
So,
Sure.
Company Audit 21-22, I would start with probably with a caveat, with a word of caution that 21-22 cannot be a copy paste year in very simple terms. Because in audit, most of the time we copy from the previous year's folder, and students are asked to just change that year date, and it becomes slightly mechanical. But then this year there are sweeping changes in the presentation of financial statements because of revised Schedule 3, and in the audit reporting format, which is CARO 2020. But before going into the specifics of those two very new areas, let me just have an intro as a run-up towards having this discussion. Audit is all about an opinion, forming an opinion about the financial statements, stating whether the financial statements, the balance sheet gives a true and fair view of the position, the P&L of the performance, and the cash flows. Cash flows have also become part of the, or falling into the definition of general purpose financial statements under Section 2, subsection 40 of the Companies Act 2013. So this is what we are reporting. Opinion is the end product of an audit, and this opinion is relied upon by multiplicity of people, multiplicity of stakeholders rather. It could be ranging from the government to the shareholders to whoever, investors, researchers. So therefore, it's very important that we discharge our onerous responsibility of audit with focus, with a great adherence to all the applicable standards and governance standards. So with that, let me move on just to give about the key aspects which you find in the audit of a company. There's a well-defined statutory framework. See, Companies Act 2013, the two important chapters for audit and auditors, whoever is dealing with accounts and auditors, there are two important chapters. Let me start with chapter 10. Chapter 10 deals with audit and auditors, sections 139 to 148. And the preceding chapter is equally important, that is accounts of companies, 128 to 138. We will discuss that as we go by. So this is statutory framework, which makes you mandatory the audit of company irrespective of its size. If you are a company, even if you are a small company, no transactions during the year, you are in the pre-operative stage gestation period, irrespective of all that, 139 mandates that the audit of companies have to be done. Companies should get their accounts audited on an annual basis. The second important key aspect is that of professional pronouncements. The ICAI over the last 73 years have been doing a yeoman job on bringing out accounting standards, which are the principles for good accounting, recognizing transactions, measuring the transactions, the value of transactions, then putting them in the financial statements, disclosures and presentation, and so on. Accounting standards. And as for auditors that we have the standards on auditing, which are mandatory now under the Companies Act also. I'll come to that a little later. And thirdly, very specific reporting requirements. CARO being one. CARO has been amended many times. Finally, CARO 2020 has got 7 new clauses. Totally new 7 clauses have been brought in here in CARO 2020. And we have IFC reporting for certain companies, then financial control reporting for certain companies. So irrespective of the size of the company, if we are doing any company audit, I would strongly suggest that all of us have some familiarity about these provisions, which I'm going to list in the next slide. This is how the Companies Act Chapter 10 would look like. When you go on to the website of MCA, today not do anything going to the website mca.gov.in. And those who are not here also, young members, we see the reading, and here also the Companies Act, or we can take downloads also. There's absolutely no problem. We can take downloads and keep it on the desktop as a folder. So Chapter 10, 139 is appointment of auditors. 140 removal, resignation of auditors giving special notice. 141 is qualification, disqualification. 142 remuneration. I'm just running through. 143 we need to pause and take some extra time on this. 143 deals with powers and duties of auditors and auditing standards. Look at that. I hope the fonts are readable. Powers and duties of auditors and auditing standards. So 143.9 has made auditing standards mandatory. One has to be extremely aware of that, and we should be applying auditing standards. The last part of my presentation would focus largely on the auditing standards. 144, as you know, there is a prohibition. Section itself is 144. Malayalam and Tamil, I think we say 144 solvanga. That is called, complete curfew kind of thing. So the statutory auditor of a company, I can come and do the project report on internal financial control, internal audit of a company in Madurai, which Venkatesh sir is auditing. As a chartered accountant, I can do that. To my audit clients, as statutory auditor, I'm prohibited from giving any other service except management services, which is, of course, subject to a lot of discussions. Audit functions are okay. We can do tax audit, GST audit, but other functions like project reports, working capital assessment, accounting services, GST filing, all those things to start corporate clients, we are not supposed to be prohibited actually under 144. 145 signing the auditor's report. 146 auditors to attend general meeting. 147 penalties, punishment for contravention. 148 is a cost audit. So this is how the sections are aligned in Chapter 10. Just for your understanding, as a recap, I was just listing this. It's very important that we have this understanding. And it's so handy today. We don't have to even stand up, look at the shelf. Now itself, I can probably go to the live website and then display something. You can just click on the section, will give you the complete reading. That we can copy, paste, edit, or store in a folder. So that's how we do the reading. And this is okay. There's a chat. Manin sir has said good evening. Good evening, sir. Okay, fine. I'll come back. Sorry. So having talked about the key aspects and the sections, the alignment of sections or arrangement of sections under Chapter 10, we will now move on to some basics, because today what has happened in most of the situations, auditing has been reduced to compilation of financial statements. Even to the article students, when sometimes you ask audit, they will say, sir, statements statements have been prepared. Of course, for smaller clients and some of our large clients, we as auditors help them to prepare financial statements because they do not have the internal machinery, internal capabilities to prepare compliant financial statements, Schedule 3, accounting standards, all those presentational requirements, and also many of them lack accounting sense. So therefore, we help them, but audit cannot be mistaken for that. That's very important. So that's why I'm touching upon some of the basics. The audit process, making sure that appointment is in order. While on that, let me also tell you that the appointment today, appointment in a general meeting is for a period of 5 years, till the conclusion of the 6th annual general meeting this day. Under the Companies Act 2013, and there was a system of ratification earlier that is gone now. So in the normal process, the first auditor is appointed within 1 month of incorporation by the board of directors. Then their term will end as of the end of the first AGM, on the conclusion of the first AGM. In the first AGM, if there are no issues, the auditor is appointed for a period of 5 years, to hold office for a period of 5 years. That's how the act is structured. So every year, appointment letter need not be insisted upon. The appointment for 5 years, that's fine. After setting all that right, Let me also here just tell you something. When I was chairman SIRC, a lot of disciplinary hearings used to happen at SIRC. One of the major reasons for that is not communicating with the previous auditors. Particularly younger members, when they get an audit, they will accept the audit, not checking whether the earlier auditor has actually resigned, or sometimes the management would say that we have removed the auditor. Management cannot do that. No company can remove the auditor before the expiry of this 5 years, except with the prior permission of the central government. That's a completely detailed different process altogether. So don't take up audits in a hurry. Even if you take up, please follow the right healthy habit or the mandatory ethical requirement of communicating with the previous auditor and getting no objection. Otherwise, you can be in trouble. Okay, therefore, that's something. The opening balance checking is something that's very important, particularly when we are getting an audit for the first time. It is not just ticking here in the audited financial statements and in the books of accounts and saying that opening balance are all right. So opening balance verification would include, if, for example, you see there's a land, general ledger account called land, which is, let's say, 2.5 crores. So the breakup of that the auditor should obtain, and also look at the originals of the title deeds. Today, originals, when I say extra emphasis on that, because in Schedule 3, as well as in CARO 2020, the auditor and the finance manager and the auditor has to say whether all the immobile properties are held in the name of the company. There's a reporting requirement. So that's a very important exercise which all of us have to do. Gone are the days where we have a thick ledger and we would put a tick here and there. The students do the matchmaking in Tally itself through the system, make sure that there are not different and it is do an evaluation of what are the controls, how frequent is the trial balance taken, all those things, how frequent the bank accounts are reconciled, stock verification is happening, aging of debtors, all those things. Am I audible?
Looks like there is a break in the
disturbance.
Yes, sir.
Members audible?
So it's audible, but there is some disturbance, sir.
There is an audio lag. Somebody had mentioned in the chat box. Is it okay now?
Now fine, sir.
Hello, sir. Please tell me.
Sir, now it is fine, sir.
Please tell me. I'm waiting to hear from you.
Sir, okay, sir. It's fine.
Codison, sir, said, yeah, sir, now it's fine. Okay, fine. Yeah, okay, good. Thank you.
Fine, sir, fine.
Yeah, so the third one, which was out, I'm talking to senior members, I'm seeing a lot of you on screen. But still, what has happened is the basic exercise of document verification or checking of transactions have disappeared. But in any audit, I think that some amount of voucher verification has to be done. I tell my students that it is not a voucher, it's a source document. The moment you call it a source document, the credibility increases. And we are supposed to check that and make sure that they have been, so sometimes may not be there. Today, the senior members, many of them, in earlier days, used to have photocopies of major ledger accounts, closing balance after making the close, and used to keep it as their reference. So therefore, that's very important. Again, it looks like there is some connectivity issue. Looks like some connectivity issue in your side. That is chairperson has mentioned. And madam, what is the disturbance? Can you tell me? Can you speak up?
In between, we feel a lot of broken voice, sir.
Okay. Let me disconnect and come back. Okay.
Yeah.
Just give me a minute. Sorry. Is the audio okay now? Madam, you have to unmute. Yeah.
Please go ahead, sir. Yes, sir.
I just share the screen. The screen is visible now. We'll go.
Yes,
Yeah.
sir.
Yes, sir.
So we were in ledger analysis. That's very important. Equally important is an exercise that we do on verification, inventory verification, verification of assets, verification of liabilities, and so on. That's a very important thing which we have to do. So I'm just trying to explain the audit process. Not that we do not know, but somehow over a period of time, we are seeing that these aspects have been slightly diluted. I think we should reinvent good auditing by referring to all this. See, if what I'm mentioning here, everything can be related to an auditing standard. Opening balance checking, for example, SA 510, standards on auditing. 510, in the case of initial engagements, it is a mandatory standard. Internal control evaluation, SA 315. Vouching ledger analysis verifications talking about the specific standard is not there, but that is talking about obtaining sufficient and appropriate evidence that the transactions are relevant, ledger accounts are proper, assets are owned, assets are free of charges, they're fairly valued, they are in the name of the company, and so on. Documents of title. All those things we have to really see, and therefore those are very important exercises. Continuing with that, analytical procedures. Now, if you look at the revised Schedule 3, there are complete detailed disclosures of financial ratios. So analytical procedures would mean, checking of ratios, trends, NP, net profit ratio, gross profit ratio. That is, they call it entity-specific checking, entity-specific, company intra-year, then industry-specific. If we have similar clients, or you can Google up and get what is the general accepted GP rate in this particular industry. So that's also there. And general macroeconomic awareness is also very important. Comparing financial statements with books of accounts. I'm asking a very simple question, How many of us obtained a detailed signed physical trial balance from the finance manager or signed at the level of a director of finance? I think this is something which is very, very important. Is the audio okay now, Venkatesh sir?
Okay, sir. Okay. Okay, sir.
Chairman is also okay, chairperson.
Yes, sir. Tell me, sir.
Yeah, okay. Yeah, so this is something which may sound very elementary, but are we really doing it is a big question. If you're not doing it, we must. Accounting standards and Ind AS compliance. In the FRRB review, we have heard, experts and our former CCMs telling us that the FRRB review findings are really, disheartening. Financial statements do not comply with accounting standards. Auditing standards, it is completely dismally poor compliance. A lot of accounting standards which the preparers of financial statements, fortunately or unfortunately, the auditor himself is preparing all the financial statements. Therefore, he has to be aware of that. Ind AS also has become applicable for many companies. All companies, listed companies, yes, small and big. All other companies with net worth exceeding 250 crores, they have to comply with Ind AS. All other companies less than 250 are still within the accounting standards regime. Schedule 3 compliance. The new Schedule 3 is exhaustive. A lot of changes have happened. And I don't know whether you have heard experts saying that looks like all these amendments have been made for a banker. Because a lot of bad loans, we have a bad loan bank also, a bad bank. And because of this, non-existent inventories, non-existent assets sitting in the balance sheet of companies. And based on that, banks are giving loans and financial support, which will all in the process become NPA. So today, many of the questions, for example, whether quarterly returns of current assets filed with banks are in agreement with the books of accounts. It's a point which Schedule 3, the management, and CARO, the auditor, has to report. We have a lot of difficulty. When we are really doing it, there's a lot of difficulty. I will tell you why. We will come to that particular point. And lastly, and most importantly, the CARO. CARO is not applicable for small companies. We'll have a threadbare discussion on CARO as we go by. So CARO is not applicable for small companies, but there are a lot of reporting new onerous, difficult reporting responsibilities under CARO 2020. So we have to do informed reporting. So this audit process I put in briefly in about 5 plus 5, 10 bullet points, something which one has to be really aware of. Are we doing all this? Quickly, we'll go back to the previous slide and see opening balance checking, internal control evaluation, vouching, ledger scrutiny verification, analytical procedures, comparing FS, trial balance, Schedule 3 compliances, and CARO points. So something which all of us must do. While talk about CARO came in 2020 February, notified. So the institute in a hurry made a guidance note, but that was off late. It was found to be slightly outdated, made in a hurry. So if you are looking at the CARO guidance note, please look at the June 22 version. Excuse me. June 22 version of CARO guidance note only you should see. The earlier guidance note is redundant and it is not having all the required points. Now we slowly move on to understand what's really new for 21-20. Really new. This is a framework we have seen. This introduction I thought may be relevant and is relevant for a discussion to take off. We set kind of a platform and reinvented ourselves into the sphere of corporate audit and so on. What is really new this year is Schedule 3 revised format. And Schedule 3 we travel through Section 129 in Chapter 9. Section 129 talks about the financial statements. In brief, it says that the financial statements of every company should be in a format given in Schedule 3. All of them. There are 3 divisions. Division 1 are small companies, in the sense that non-Ind AS companies, with companies having net worth of less than 250 crores. So they are small, I mean, in the sense accounting standards companies. For them, it is Division 1. Ind AS companies have to follow Division 2. And NBFCs have to follow Division 3. So there are 3 divisions under the Companies Act, the form and format of financial statements. In all the Schedule 6, we used to have only one format. Horizontal format is also allowed. Now there is no horizontal format, it's only the vertical format. And CARO 2020, sweeping changes in the auditor's responsibilities, one has to be extremely careful. But we will discuss all the points threadbare, particularly the new points, the thrust on new points we'll discuss. That's all we can probably do in a 2-hour session. and then we'll have some Q&A towards the end. Now, Schedule 3, what are the major changes? I put all the changes, though I have captioned it as major changes. All the changes I've listed here. Rounding off has become mandatory. The smallest is into hundreds, and you can go up to crores. If your total income is more than 100 crores, you can round it off to the nearest crore or million or lakhs. Lesser, smaller companies can go up to hundreds. So yesterday I had a message from a member, got him. He asked, how do you round off to hundreds? If my figure is 1,23,000, I'll just check the figure, exact figure. Give me a minute. Rounding up, there are a lot of doubts whether decimal should be there. What will we do with income tax and so on? Just give me a minute. So 1,23,282 is a figure. So how do we round 3? 82 will go, and 82, 8 being more than 5, we will say 1,233. 1,97,856 in thousands. In thousands, if you put, it will become 198. This is the understanding we should clearly have. Income tax probably in full amount, but it's only the total income. In the uploaded financial statements, I am of the opinion, I'm not a tax expert, I am of the opinion that these rounded off financial statements should be okay. And they can make sense out of it. IT computation, I think we have to give all the full amount in detail, and naturally that is what will go into the IT return. The terminology of tangible assets, which is still there on the face of the balance sheet, now that has been replaced with the word property, plant and equipment, which is common. The accounting standard 10 also has been renamed as property, plant and equipment. Disclosure of promoter shareholding, that is something new. In the notes in share capital, we were showing this more than 5% shareholding. The details of people who are or members who are holding, shareholders holding more than 5%. Below that, now there has come a requirement of promoter shareholding also should be disclosed. Promoters defined under that act was started the company. Having a reverse Schedule 3. And aging, SIRC's Schedule 3, if you look at, they're saying that figures, if they're old, what is old is bad. Figures, I mean. So aging one now has happened for capital work in progress, intangibles under development, trade payables, trade receivables, of course, we are there. So on the 5-column tabulation we have to give. And one more thing which I would like to say here is that at least your large clients, please send a communication to them that these are the changes and ask them to keep the information ready. About 1,600 participants, online session 3 and Caro 2020. At the branch level, I thought I will focus on that. Plus, we'll discuss all the other relevant aspects. That's how the caption has been changed to company audit, all you need to know. Sorry, Mr. Jomon, voice is breaking frequently. I'm having a signal here, strong signal here. Madam, are you hearing me?
Yes, sir.
These proceeds are now, it is okay. But still it's a disturbance. Let me just check. Just give me a minute. I'll switch to another connection. Just give me 30 seconds. Okay.
Yeah, yes, sir.
Finally, there's no problem here.
So please go ahead, sir.
Ma'am, it is audible. Am I audible? Can we proceed?
Yeah, yeah, yes, sir.
Or some of the members can unmute and respond.
Okay, sir. You can go ahead, sir.
Okay, sir.
Okay,
You can
okay,
carry
sir.
on.
Am I audible now?
Yes, sir.
Yes, sir. Yes, sir. Yes, sir.
So you may proceed,
Yes,
sir.
sir.
Audible, sir.
Chairperson, because I have full signal here. Okay.
Okay, sir.
I think we were in this an aging and date of completion. There's a thinking that age it's only aging expect. Just give me a minute, I'll just come back. Sorry, sir. I'll get the LAN cable connected. Am I audible now, Venkatesh sir?
Yeah, fine, sir.
Yeah, I'll just get my LAN cable connected in 30 seconds so that there'll not be any further. Extremely sorry for this. Doesn't happen normally. No. Madam, sirs, I'm back. I hope I'm audible now.
Yes, sure. Please.
Sorry for the trouble. And in our office, in most cases, we get signature of the concerned staff in trial balance. In some cases, we get the tally backup also. If any more requirement for peer review purpose also may be explained. Yeah, Jayashilan sir. Yeah. Okay, sure. That's enough, sir. In our most of the cases, get the connected concerned staff. You go to slightly higher level. Let the finance manager come into the trial balance. And also, we prepare the subschedules or the groupings. I would make it sure that, of course, we get the tally data. The client is not bothered. In fact, data security is a concern. All the students carry this client data in their laptops when they travel. The day they reach the client office, they are happily giving it. We'll give you the tally data. You can work from home also, work from office also. But then we make the students take an oath of confidentiality, but it's purely trust-based. And they can really play around with the data if they want. And finally, this has to be together because after auditing, this maybe some entries are passed this way, that way, which we are not supposed to do, but it happens. Finally, there should be a final trial balance. That is why I'm saying a printout of the trial balance. I hope I have explained your point, Jayashilan sir. Yeah. Moving on, we will have this. So, yeah. Aging and completion of capital work in progress and intangibles under development. That's a important thing, which just yeah. So capital work in progress. What happens is there may be capital work in progress for 2 years, 3 years, going on indefinitely. So is the project suspended? There are a lot of issues which we have to disclose, and then what is the expected date of completion? Or for some reasons, in Kerala today, we have a lot of environmental issues. We have buffer zones. I think that will happen in Tamil Nadu also. Ecologically fragile areas. Some of the constructions have been given stop memo. So that may remain work in progress, capital work in progress. But finally, it may have to be written off if it's not realizable. So those points are what they are trying to highlight. Same is the case with intangibles under development. For the new generation IT companies, startups, what they will do is, first year they'll have some rent, salary, some expenditure. They will say that these are all for developing a software. Startups only 10% will blossom. Other 90% will not be successful. That is a statistics. It is not that it's not a wish that I'm making. It's not my statement. Experts like Crisco Balash and all have said, and statistics gives the data that is only 10% who would blossom. So first year is okay, second year is okay. Then for 3 years, they are going at engineer salary. 10 engineers are sitting together, calling themselves a startup. Balance sheet in the balance sheet, they are having it as an intangible under development. So this cannot indefinitely go on. So therefore, they're asking intangibles under development, aging, as well as the date of completion has to be given. Now the new the other changes are like current maturities of long-term borrowings. We were showing under current liabilities. Now this has to be shown under short-term borrowings. I'm professionally and personally against this, but this is the requirement of law. Current maturities of long-term borrowings should be under current liabilities only according to me. Short-term borrowings, those who are working on the working capital assessment and related services to clients would know that anyway in the CMFO, which is still being used, the current liabilities, 12 months installments falling after balance sheet are shown as current liabilities only. Aging of trade payables, not trade receivables, sir. Aging of trade payables. Other one, the MSMEs we have to give separately. MSMEs less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, and total we have to give. And billed and unbilled also has to be given separately. This is a new requirement, a format has to be given. So once again, I am suggesting, including to the senior members, that let us try to get the maximum of this work done by the staff. And today Tally enables the aging, and therefore that also they should use, and we should reduce our clerical time on audits. The next one is the aging of trade receivables, disputed and undisputed separately, less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, and the total. So this is how the disclosure requirements of debtors and creditors and current maturities of long-term debts are. The next one is details of immobile properties not held in the name of the company. I think we should have an interaction here. In all the presentations I did for members, I did some for students as well. Last week we had a presentation, slightly on a different format. So can this really happen, sir? Immobile properties in the balance sheet of the company has to be in the name of the company. Can any other asset or immobile property be shown in the balance sheet? Can we have some interaction? Can the admin unmute the participants? Is there a situation like this? In Kerala, the only situation I remember was earlier Companies Act, there was called Chapter 9 conversion. A partnership was getting converted through a corporate law process. Company law process in the Chapter 9 conversion, we used to call it. So the firm was getting converted into a company, and all the assets of the firm will get vested into the company. But in the village records, they will not do the mutation saying this. We show them the new certificate of incorporation, the order issued by the registrar of companies. So they will have to be shown in the company books of the company, financial statements of the company. Other than this, there is no other situation that companies can have assets not in the name of the company shown in the balance sheet. I am open for a discussion. Probably we'll have a Q&A towards the end if there are no questions at this point of time. I'm not asking for questions, I am asking for inputs from you. If there's a revaluation during there, they have to say whether revaluation has been done by a registered valuer, which is under 247. Land will be in the name of the director. No, Sundarayan sir, it cannot be. Land in the name of the director cannot be shown in the company's books. Building constructed by the company. Sir, the landowner, only the landowner will get building permit. Ninga building permit check pananga. Company would have incurred the expenditure, but building permit and land has to be in the same name only. Otherwise, it should be through a backdoor process. Can I get a building permit in your residential property? That is my understanding. I'm open for a debate. Now, to the chat box, Sundarayana sir said, land will be in the name of the company. Nare Pandranga sir, that should not be done that way. In the Middle East, this is a common practice. The Emirati would say that, okay, there is a capital shortage. Bank wants more capital. So you will say that Media City, I have one plot. This is the document. The title deed is like a certificate or share certificate. So this is my title deed. This is a value, current market value, you put it. They just pass an entry, land account debtor to shareholders current account. So capital sufficient is capital deficit is met, capital adequacy requirements are met. There, I don't know whether it is allowed, but here it cannot be done. I'm very clear on that. That's why I invited a discussion, but we'll continue to discuss. The amount of change in revaluation, if that's resulting in more than 10% variation upward or downward on the net carrying value, the full details of the revaluation also has to be given. Utilization of borrowings, this used to be only in the CARO, but now the Schedule 3 also requires the management to say whether the borrowings, this is, according to me, this is only for long-term borrowings. Long-term borrowings have been utilized for the purposes for which they have been taken. A lot of fund diversions happen. Now, what is happening in the higher sphere of corporate activity? There are a large number of fraudulent players. What they're doing is they will show a fake project report and then say that this is what we want and loan will get sanctioned. They will take out the funds and invest in private property, invest in some other real estate, etc. So you are saying that I want to construct a factory building in Madurai or Shivagashi, then I'm taking a loan. The loan is sanctioned, and then I'm utilizing for my foreign travel or for having a very, the grand Indian wedding kind of thing for a family member, daughter or son. That cannot happen. So they have to be very clearly mentioned. We are still talking about Schedule 3 only. One more chat. Land of the director taken on long-term lease, building constructed by the company. The building only in the accounts. That is fine, sir. Land of the director is taken on long-term lease by the company, Pakka, and building constructed by the company. No problem. The building only in the accounts and depreciation claim. That's okay. No problem. So if there is a lease agreement, lease deposit, lease rentals, that should also be taken care of. Otherwise, you are right. Now, I did mention this. The next bullet point is whether quarterly returns of current assets filed with the banks are in agreement with books of accounts. Now, most of you may be doing concurrent audit. I'm not doing any now. Concurrent audit, what's happening is, the quarterly returns. I'm saying lease property in the name of the company and building constructed by the company. That's also okay. The building or the lease property is in the name of the company. Company has taken property on long-term lease and company gets a construction license. No problem. That's okay. That will not be that is in the name of the company. Land property in the name of the company because leasehold. It is not freehold. That will not invite a qualification here. Quarterly returns, we are filing of mostly of inventories and receivables. Receivables, at least we can say that get a trial balance as on the quarter end, and schedule of debtors we see more or less. If there are small differences, we can disregard, but major differences have to be reconciled and reported. But stock, most of the cases, big and small companies alike, they are giving something like a ballpark figure to meet the DP requirement. Sometimes they need more DP, drawing power. Adhikaga, they'll show some hiked up figure, but it will be based on the books of accounts. So books of accounts, it should be the stock register in the case of inventory. Receivables, we have the financial ledger. That also we have to make sure it is on that basis. And the inventories have to be, inventories have to be in agreement to put the stock register, abstract of the stock register based on that. Otherwise, we have to qualify. A few cases we have already qualified. So if the bankers want to take action, if the ministry wants to take action, that's the only way. And they have been warned that going forward, this should not be artificially hacked up. Whether the company has been declared a willful defaulter. They have referred to the RBI master circular on who are willful defaulters. Two reasons are. One is that they are very adamant. They may have the resources, but they say that, no, I'm not going to pay. It is like Manoharan sir once said, somebody took a loan and then when he was asked to repay, he said, it is against my principle to pay interest and it is against my interest to pay the principal. So neither principal nor interest will get paid. So therefore, one has to be careful and if a willful defaulter, and again, there will naturally be defaults and the siphoning of funds will also be there if a willful default. So that has to be done. And the third one is registration and satisfaction of charges. Now, those who are practicing company law, you would know. Now, for registration, we have 120 days. And for registering satisfaction of charge, we have 30 days. It cannot be registered beyond that without going to the regional director. So the question here is whether registration and satisfaction of charges have been done on time. If not, you report with the details. Details of loans and advances given to related parties. Oh my God. This is something which related parties, loans are being given to directors and without any this thing. And there's a huge danger of income tax 222E also. If you're a profit-making company and if you have debit balance in the director's account, the department can send you a notice and tax that as 222E deemed dividend. That separates from a tax angle. Companies Act here, the Schedule 3 requirement is that all the details of loans and advances given to related parties, key managerial personnel, managing director, his family members, all those things, all of them have to be given in detail in the Schedule 3 format. Whether any proceedings have been initiated against the company under the Benami Transactions Prohibition Act. We should ask a letter of representation. Now, most important thing which will come towards the end of this presentation is that we should get all the new things got in writing from the management. That's very, very important. So then also check with the legal fees or something is there. You can also communicate with the legal counsel. There's absolutely no problem. And therefore, we have to make sure that there is no notice or action initiated. Whether the company has acted as an intermediary in a money laundering transaction. This is there in the company, Schedule 3 as well as in the, I have made it very brief, but it is given a wording that whether the company has received or advanced any sum from any party, including foreign entities, and acted as a subsidiary for some other ultimate beneficiary. I used to give this example. There's a company in UAE. They have no business with you, but suddenly they are saying, because of some nexus you have, some unholy nexus you have, they are saying that boss, we have to transfer some money to Sri Lanka. Directly we cannot do, we don't want our identity there. So what we will do is we will transfer 500,000 dirhams to you in Madurai or Cochin. And in turn, please transfer that to the company which we give the details of in Sri Lanka. I'm just giving, it could be any other country, it can be domestic also. Somebody from Delhi giving some funds to Madurai, giving you the direction that you give it to Gujarat or give it to Kolkata. This can happen. Geographic territories are not very important. They say including foreign entities. They are all money laundering transactions. So we have a PML Act. Here, the question before the management has to disclose is whether the company has acted as an arm, as a component in this unhealthy transaction of UAE money coming to India and that getting quickly transmitted, which is not related to the business of the entity at all, quickly getting transmitted to Sri Lanka. If that is the case, then that has to be given, the full details. Details of transactions struck off companies. 560 under the old act and 249, I think, under the new act. Whether this company or Audit company has, this is again by the management, Schedule 3, we're still in Schedule 3. Whether has had transactions with companies which have already been struck off. But there's a normal running transaction that doesn't arouse a suspicion. But here is where there's a straight transaction with one company. And then you can probably, with the name of that particular company, or if you get the SIN of that company, go to the MCA website and see whether the name has been struck off or not. I'm having a slight sore throat. I may be excused for sipping a tea in between. So this is something which one has to be extremely careful. So talking about that, the getting the information and going to the MCA website. So there's a thinking. And the auditor, I say, really required to go to that extent. And are we going out of the way? And people are still saying that the auditor is only a watchdog, not a blood dog. That I don't think holds good anymore. Because demanding reporting responsibilities, the way the regulator looks at the profession and the individuals, members of the profession, one has to be extremely careful. And therefore, holding on to the Kingston Cotton Mills case, delivered more than 150 years back as an insurance policy, I don't think it is safe anymore. Therefore, we have to do all that is required to be done. Qualification, adverse remarks, emphasis on matter paragraphs, communicating with the management, blowing the whistle louder sometimes. All those things are very important. So I was just trying to say that suck off companies when we go to that extent. So one has to be extremely careful, particularly in the sphere of larger audits. There is now QRB is there, NAFRA is there, institutes checking is there, and NAFRA is really flexing its muscle. I hope some of you would have seen the report of against Deloitte in the ILNFS, which is a public document. I'm not referring a particular firm or a particular corporate failure or corporate irregularity. But there again, the 309 page report, the brief of that report, if you ask me, the crux of that report is that the experienced auditing firm with multinational links failed to obtain sufficient appropriate evidence before forming an opinion on the financial statement. There's nothing on record to show. And the irregularities to the tune of some 92,000 crores in ILNFS. One has to be extremely careful. The other one is whether provisions of section 2, subsection 87 on number of layers have been complied with. Under the Companies Act 2013, in a vertical system of holding and subsidiaries, there can only be 3 layers now. A company having a subsidiary as B as its subsidiary, and B can have a subsidiary of C. You should stop there. A, B, C, vertically. Horizontally, you can have as many as you want. There's no restriction. Vertically, A, B, C. But an exemption is there. If any of these 2 are 100% subsidiaries, you can go to one level down. I'll give this example. A company has got a 100% subsidiary B. Then it can go to C and one more level, D, vertically. That is what 287 in brief says. So whether there are subsidiaries, etc., whether the number of layers provision under 2 subsection 87 has been complied with. Who's to give all this? The management. This is part of the financial statements. We have not yet come to CARO. That we will go a little later. Okay. Full details of CSR expenses. If CSR is applicable, 1,000 crores of turnover, 500 crores of net worth, 5 crores of profit. Any of these conditions are satisfied, you fall into the ambit of CSR. So we recently did a presentation in Rotary Club for the district program for our district. And we have DRFC, those who are Rotarians would know. DRFC this year for our district is Chella Raghavan from Coimbatore. Most of you might know him. NC Krishnan & Co. and a very predicated firm. And I did this presentation to familiarize the Rotarians and corporates with the provisions of CSR. Because Rotary funding can happen through CSR. So if CSR is applicable, and then we have to give the complete details of CSR expenses, spent, unspent, how much should have been spent. We have to verify the minutes of the CSR committee, the board, and all those things based on that complete details will have to be given. Details of crypto transactions, if any, which the company has entered in. Cryptocurrency, you would have seen this time IPL 20 and the IPL 2022 season, which is a Tata IPL. The maximum advertisements, the advertisements on TV were of commodity, the exchanges, what they call it, crypto exchanges, and new gen companies, gaming companies like Game 11, Game 11, what kind of advertisements they used to do? Dream 11. Dream Big, Dream 11. It's a gaming company. So they're in the new line of business and people are really addicted, making crores and crores on every match that is getting played. Of course, the prize money gets tedious. Government also gets tedious, and at 30%. But there are a lot of interesting statistics. So this is about the transactions. Moving on. Revised Schedule 3 requests the financial statements to contain ratios, and if there are more than 25% or more variation as compared to the previous year, the reason for that has to be, the reason for the variance should also be explained. Current ratio, debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio. Inventory turnover ratio, at the first glance, we said it is inventory divided by turnover. It is not so. It is turnover divided by inventory, average inventory. Number of times the turnover. Same is the case with trade receivables, trade payable turnover ratio, net capital turnover ratio, net profit ratio, return on capital employed, return on investment. If you look at the guidance note, I would suggest this area I think you can leave out. Guidance note is not mandatory in the first place. And if you look at the area of return on investment in the guidance note, you will go nuts, given some sigma formula and all that. That is from an investor's perspective that I tried to explain. For a company return on investment, when you calculate 10%, it is nothing but PAT divided by the total assets. That's all we have to do. Simplify the process, and we have to give the formula also. And this we have to do. See, where do we give all this? When we are preparing financial statement or saying that, okay, Venkatesh sir is the CFO of a company. First time we are preparing financial statements. Where do we put all this? Scattered pannama, lenge pannama. See, what we have done is all the intangible assets and tangible assets related would be under that particular schedule. But general things in the previous slide, as we have seen, the ratios is one thing which we give, and the CSR expenses, crypto transactions, stock of companies, all those things. So we have now in our presentation, I hope you received the format which I sent you more than a month back. I sent to all the members in South the Excel format of Schedule 3 and the Caro report, draft Caro report. And also a few days later, I had sent the MRL also, draft of a management representation. If you haven't received, it was a mass mail to the all of South. If you haven't received it, please get in touch with me. I can surely share that with you. There is no IPR. Of course, some homework has been done. Me and a few of our assistants sat together and then framed this format. Then we thought, why should everyone reinvent the wheel? Why don't we share this with the members? And therefore, that was sent. But I'm only happy to share if some of you would need that later or something. You're always free to contact me. So that's how we do this. And we now show all these general items under a heading called additional regulatory information. Probably you can even put as mandated by the revised Schedule 3 by virtue of whatever notification that we can show. So to that extent, these financial statements have so many of the additional disclosures. Moving on, we have in the P&L also there are some changes. The term total revenue. Oh, thank you so much, sir. Sundarajan sir said your formats were very nice and useful. Thank you. Honored. Total revenue is replaced with the total income. These are our terminology changes. If you are doing the audit of, we prepare the FS of Section 8 company, we prepare only income and expenditure, no PR, right? Because they are non-profit companies. They are put in a separate line item called grants and donations received as a Section 8 company. Okay. Then the last point is also something which is new, to give full details of unrecorded transaction surrendered but disclosed in IT assessments. No, it can happen that we are doing the audit of 21-22. 21-22, let us assume or rather hypothetically say that there has been a search and it has been finalized and an additional assets of worth 2 crores have been detected by the department. Everything else is okay. Finally, on the last date of the search, they found a title deed of a property, 2 crores. So the accounting or rather sensible accounting requires that though it is left out for whatever reason, now that it has come to the surface, it should be captured in the books of accounts. So the accounting entry we will have to pass is land account debtor 2 crores. Assuming you are paying 20% tax on that, provision for taxation 1.2 crores and 80 lakhs of revenue you would show on that and take it to the P&L account. That has to be done. So the point is that's the practical aspect of it. From a disclosure thing on Schedule 3, what they're saying is, if there has been the unrecorded transactions of the past detected and surrendered, disclosed in IT assessments during the year, they have to be brought into the books of accounts. If not, we have to report. That's the point. That is the last slide on Schedule 3. When it comes to Schedule 3, and that with that we would move on to Caro 2020. But before that, we can probably pause for a minute and have some questions taken. If there are some, I can unmute the participants or chairman can. We can wait for 1 minute. You can put in the chat box also or shoot unmuting yourself. Otherwise, we can move on to Caro.
So this rounding off is mandatory, sir.
Yeah, it is mandatory.
And what will happen, like when we get UDIN, we are supposed to take UDIN with the actual full figures. So will there be any issue in giving the You didn't like any difference in.
No, you didn't in the new format. You didn't have to take with the round off figures only.
Okay.
That's what I was giving this example, ma'am. You have 1,23,000. How much did I say? 1,23,282.
Yeah, I got that.
Okay.
So when we take UDIN also, we'll have to take in the.
Round off the balance sheet figures, right? We don't have to expand that.
Okay, right. Thank you, sir.
Any other question? Shall we move on to CARO 2020? I'll proceed, Venkatesh sir. Yeah, okay. Now, CARO 2020 was originally introduced in February 2020. Initially, we thought it will come into place in 1920. It did not. 2021 was also deferred. Finally, in the financial year 21-22, it has been made applicable. The overview of the order, if you see, there are new clauses, including 2 reintroduced clauses. There are 7 new clauses. Modified clauses, there are 7. Old clauses retained as it is 7. So put together, there's 21 clauses and 47 subclauses. That's how moving forward, we'll just look at the summary of changes which are there. Summary of changes, we have the new clauses, transactions not recorded in the books. Just 2 minutes back we discussed. That was with reference to Schedule 3, what the preparers of financial statements have to give. Here in the CARO also, there's a specific reporting requirement, whether transactions previously unrecorded have been detected during the year-end income tax assessment and whether they have been properly accounted or not. The ability of the company to meet its liabilities. This is something new, this is very onerous. But today they are asking us to refer to the financial ratios which are available handy in the notes on accounts. Just 3 minutes back, we had seen that financial ratios also should be disclosed in the notes on accounts. Now, ability to meet the company's liabilities is really tough for the auditor. So far, the auditor was required to have hindsight and then knowledge of the present. Now he is required to look into the future and say whether the company will go on or company will be able to pay its liabilities. So somebody in lighter vein was saying that anyway, Institute is making a lot of changes. Final syllabus, why don't they include a 20 marks paper on astrology also? We call it Jyotisham in Malayalam, in lighter vein. But yes, to some extent, yes. But there are methodologies which have been suggested, and it is not about the indefinite future. The auditor has to report on the ability of the company to meet its liabilities within 1 year from the, whichever is falling due within 1 year from the date of the balance sheet only. CSR, transfer of unspent amount to fund, that we will see. I don't know whether many companies in Madurai are under CSR. Listed companies, of course, they have to, and other companies, this is the limit which they have said. I mentioned that 100,000 crores of turnover, 500 crores of net worth, or net profit of 5 crores. The third clause, so many of them would fall into here. Net profit exceeds 5 crores, then yes, CSR would become applicable. 135 will come to play, and you'll have to spend the average 2% of the average net profits of the preceding 3 years. That's how it is. Consolidated financial statements. See, CARO is not applicable for consolidated financial statements. But if there are qualifications in the audit report of in CARO or report of the subsidiaries or rather components, then the auditor of the holding company the holding company in the sense that consolidated financial statements, holding company when it is presenting, he'll have to give the details of the qualifications of the component auditors. Per se, it is not the complete applicability of CARO. The last are the 2 newly introduced, reintroduced clauses. Internal audit system, other on the Pudusa, they have added one extra point, whether the statutory auditor has seen the reports of the internal audit. And lastly, cash loss. Again, whether the company has incurred cash loss during the year or also in the previous year. That's how he has to report. There are modifications on fixed assets, inventory, loans granted by the company, default and repayment of dues, reporting of frauds, Nidhi company registration with RBI, etc. So applicability, yes, from 1st April, financial year commencing on or after 1st April, it is applicable. Every company, including a foreign company, government company, branches, it's applicable. If the head office is subject to CARO, applicable, CARO is applicable to head office. It will apply to branches as well. Then branches. Exemptions are banking company, insurance company, Section 8 company, one-person company, and small company. In fact, there is another clause on private limited, but over a period of time, the deliberations say that if a small company is exempt, then the clause on other private companies have become redundant. There are certain limits they had mentioned, but the guidance note also clearly says a small company under the Act shall be exempt, even if it falls under any other eligible category. So a small company definition we'll see as we go by. So till such time, these are the companies to which CARO is not applicable. Banking, insurance, Section 8 company, one-person company, and small company as defined in the Section 285. We'll see new clauses in a different order slightly. Internal audit system, look at the first bullet point. Whether the company has an internal audit system commensurate with the size of the company and the nature of its business. So this we have been asking the management. They say that, yes, sir, internal audit is very much there. Who is doing it is an audit firm. Audit firm is not there, sir. Internally, our people themselves are doing internal audit. Okay. Then you ask, what is that? Normally we ask for, is there any report? Is there any finding? Is there any minutes of the discussions? Listen, that's an internal matter we discuss on a daily basis and finish off. Now tell me, look at the second bullet point, and we cannot be satisfied with this. Whether the reports of the internal auditor for the period under audit were considered by the statutory auditor. The report the statutory auditor will have to say that we have not been able to obtain, or we say that the internal auditors have not issued any report during the period. And we have to obtain copies also for our records. Now, what is happening is, when we talk about documentation, today the new gen students and many of our offices today have started digitizing documentation to the extent possible. So instead of asking for 3 bound books of internal audit report, we ask them to scan it. Probably they have soft copies shared by the internal auditor. Get the scanned one and keep it in a folder in the system. The thickness of the working notes files are getting reduced day after day. But internally, this documentation should be there. There should be proper backup and so on. One day it should not disappear all of a sudden. The hard disk collapsed and all those things cannot happen. I hope all of us are doing the data backup on a regular basis. And COVID also taught us into new modalities like working from home on VPNs and having the server access from anywhere. That could happen. So those kind of improvements have to happen. So here, cutting short on the general things, the reporting requirement is whether the report of the internal auditors for the period under audit were considered by the statutory auditor. If not, he has to clearly report. Cash loss. The Munadi in this is also reintroduced. Whether the company has incurred cash losses in the financial year and in the immediately preceding financial year, if so, state the amount of cash loss. Unrecorded income, this we have seen already. 1 minute. Sir, I'll take a 20. Sir, I'm back. Is there any new chat? Okay, right. So this we have already discussed in the context of our chat on the Schedule 3. Auditor also has to report whether any transactions not recorded in the books and now detected have been properly recorded in the books of accounts during the year. So there's an argument that in the example that I gave, that 80 lakhs net of tax provision, whatever is there, should go to capital reserve. I was not agreeing to that, and therefore I think it's revenue only. Because of unconcealed or concealed income that this is, accumulated income that this is resulted in this 2 crores of asset getting detected. So that's how it is. So this is a clause number 3. So clause 1 on internal audit, clause 2 on cash flows, and yeah. Thank you, Manin sir. Slides are very, very useful. I'll share the slides with the branch, sir. There's no problem. I don't attach any IPR to this. Of course, some work has been done. No problem in sharing with my fellow colleagues. Because everyone do not have to reinvent the wheel. Going back to the schedule and reading all that. This is a concise form. Happy. Thank you for acknowledging the work. And on professional matters, I'm only happy to be in interaction with the members, which I've been doing. And physically now travel is less. But Kerala, all the branches except Kannur, I visited physically and we had sessions. Previously recorded income has been properly recorded in the books of accounts. Example I've already given. Now, resignation of the statutory auditor. Sirs, you would remember that 2 years back, there are a lot of resignations, audit resignations, particularly by large firms. Like example, PricewaterhouseCoopers, if I remember correctly, resigned from the audit of Anil Ambani company, but it was Reliance Communications. And the reason they cited was we are not able to obtain sufficient appropriate evidence. So reasons have to be clear, and MCA is also giving clear instruction for the auditor. You cannot just resign by saying due to certain professional reasons, we are resigning from the audit. But then they cannot take any action. The auditor cannot give all the reasons. And auditors are asked to be more specific, very specific on what happened. Tell us what really happened, management non-cooperation. Or you have found something which you find it difficult to work with, or if you report it, they are asking not to report, and concealing that would be, will be put the public interest in jeopardy, and that can happen. So here the requirement is this: the previous auditor, the new auditor we are getting because he has resigned, should communicate with him and make sure get from him all the information what led to the resignation, and based on that, the new auditor has to report. Now, this is what we mentioned, the astrology point. In astrology, we can have on the basis of financial ratios, aging and expected dates of realization of financial assets and payment of financial liabilities, other information accompanying financial statements, the auditor's knowledge of board of directors and management plans, whether the auditors of the opinion that no material uncertainty exists as on the date of the audit report that company is capable of meeting its liabilities existing at the date of balance sheet, as and when they fall due within a period of 1 year. So it is not an indefinite foresight that the auditor is asked to have. I think this is kind of okay, though this is not really warranted. This is again from a banker's point of view that they have all done. And I know many of the people are saying that Amarjit Chopra sir was one who has been very actively involved in past President Amarjit Chopra has been active in the amendment of Schedule 3 as well as CARO 2020. I saw, don't quote me, I heard from some circles. And in layman's terms, they have bankified, make it bank friendly, bankified both Schedule 3 and CARO 2020. So with all this, the financial ratios are favorable. The going is good, profit-making company. We don't have a challenge here. Payables, receivables, there's good liquidity. Cash flow is there. Order positions are good. Industry by and large is doing good. But would not have been the case. For example, if this close was there 2 years back, and when COVID was there, how do we give a report like this on, for example, hospitality industry? Tourism industry. Take for example, you have resorts which are there in Madurai, which are there in Kodaikanal, Udagai, Munnar, Wayanad. All of you, many of you have come to all the stations in Kerala. So they have gone through very, very bad times. And the good news is that they are now back on track. Most of them are getting good booking. Now in Kerala, I've seen travel to Munnar for Pondicherry and Chengalpet branch on the same topic. That is a few months back. And also to Kumali, I went to Munnar for Coimbatore branch. Our dear friend Palanisamy is the chairman this year. So travel to Kumaragam, backwater place. Everywhere it's 100% booked. Weekends are even small resorts are fully booked. People are now started traveling. This is something which I don't know whether you have heard this term. It's called the revenge economy, revenge spending, revenge tourism. Rich people who used to travel 3-4 times abroad with family every year could not travel. Now they're all waiting, like elastic getting released. They have the money, the resources. Now the external travel is slowly picking up. So they'll all go for European tour or US tour or other countries, Middle East, Russia. Russia, nobody would go there. But I think the neighboring countries, Azerbaijan, a lot of tourism is happening. And inbound tourism is also will slowly improve. Domestic tourism itself is sufficient to feed all these. The Northeast traveling to South and some of us going to Delhi or either as a tourist or a pilgrim, as a pilgrim, is all business. So therefore, that is slowly coming back. So not to stray from this point, but looking at all the financial ratios, upcoming liabilities, the position of receivables, all the receivables are within, let's say, less than 6 months. But if the receivables, majority of them are more than 3 years old, they cannot be really called good and realizable. So one has to take a point, and based on this has to be the point. Transfer of CSR amounts to funds. So, sir, CSR is a generic clause, but still, for the sake of clarity, I would like to explain that there is 135.5 and 135.6. This new section makes a distinction between ongoing projects and other than ongoing projects. Other than ongoing projects means they are multi-year projects, but not more than 3 years. It will transcend into, it will jump over 1 year, maybe 2 years also, up to 3 years it can go. They're called ongoing projects. So there, if there are unspent amounts,
sir, good evening, sir. The OTP மட்டும் வந்திருக்கும் சார், கொஞ்சம் forward பண்ணி விடுங்க சார்.
என்கிட்ட OTP இல்ல சார், என்ன பண்ண முடியும் நாங்க? Manan sir, I agree that the Manan sir has said undue responsibility cast upon the auditors by new clause. I fully agree. I did say that we are on the same page, not for this, but having come, then what is that we are going to do? We will have to comply and get all the required information, management representation. SA 580. I'm coming to that towards the end of this presentation. So therefore, we will surely discuss. I agree with you. I think all of us here on screen who are not here also, we feel that this is too much of an onerous, undue responsibility. That's the right term to use on the auditors. The profession is getting excused to some extent, in the sense that they are doubting the profession. Not without reason. There are a lot of unscrupulous players in the profession, very unfortunately. Numbers are increasing, self-interest and quick money. Many of the good practices, the seniors like you followed, they were not able to, youngsters are not catching up with that. And in the higher realms of this thing, today, yesterday, the ICAI has issued notice for, fake compliances shown by Chinese firms operating in India by chartered accountants. GST, what happened in Gurgaon? You heard only one side of the story. But what made the officers of the GST department overreact and manhandle is a different story that we have not heard. The scene is completely different there. Aligning with unscrupulous businessmen, there are a lot of issues. Anyway, I agree with your point. We'll continue to discuss. So if it's an ongoing project, let's say that this year's requirement, first year CSR is becoming applicable. This year's CSR spend should be 10 crores. Other one, you are saying that, okay, we will put 6 crores into ongoing projects and 4 crores into other than ongoing projects. So of the 6 crores, which you have earmarked, At the end of the financial year, you have incurred only 4 crores. Balance 2 crores, you should put it in a bank account. The amount should be there within a period of 1 month. Should spend in a 1 month. From the end of the financial year, you should put it to be used from a capital gains accounts. You should utilize that within put it in within 1 month of the end of the financial year to be utilized for the ongoing projects. So balance, we have 4 crores to be spent on other than, ongoing projects. Other than ongoing projects, meaning they have to be completed within this year itself. But as on 31st March, unfortunately, of the 4 crores, you could spend only 3 crores. Balance 1 crore is gone. You have to earmark it and transfer to Prime Minister's Fund or any of the funds mentioned in there within a period of 6 months. So this is the difference between 135.5 and 135.6. Ongoing, other than ongoing projects, is something which is very, very taxing in the sense that CSR came in as a very friendly provision. Today it's not very friendly. The penalties for non-compliance going up to 25 lakhs, and therefore one has to be in charge. And CSR consulting also, we had formed a CSR policy for a company in Kerala. A listed company approached us and we did frame the policy, and then we had a few sittings, deliberations with the CSR committee and the board also. And we brought them some good NGOs also, as they could marry.
அந்த ஓடிபி வந்திருக்கும் சார், பார்த்து சொல்லுங்க, நான் ஃபைல் பண்ணிட்டேன். சன் பிரஸ்க்கு சார் ஜிஎஸ்டி.
Sir is generating OTP every 10 seconds.
இல்ல நான் இப்ப கொஞ்சம் ஃப்ரீயா தான் இருக்கேன், பண்ணிட்டேன். சரி, நாளைக்கு சொல்றேன்னா சொல்லுங்க. இல்ல அப்படியே ஃபார்வர்ட் பண்ணி விட்டுருங்களேன் சார் எனக்கு. இந்த இப்போ பேசிட்டு இருக்க நம்பருக்கே வாட்ஸ்அப்புக்கு அப்படியே அனுப்பி விட்டுருங்க, எதுக்குனாலும் சரி. ஹலோ, ஃபார்வர்ட் பண்ணி விட்டுருங்க சார்.
Okay, yeah, okay, fine. So this I did mention that whether there have been any qualifications or adverse remarks by respective auditors in the Caro reports of.
சார் போட்டோ ஒன்னு வந்திருக்கு, நான் பார்த்துட்டு கூப்பிடுறேன்.
You can mute the participants, sir. Venkatesh sir, you can mute the participants, then we can unmute. There's a smiley in the chat box. I too laugh loudly. No problem, sir. Vele should also happen. No, work should also go on. Yeah. So if yes, indicate the details of the companies and paragraph numbers in the Caro report containing qualifications or adverse numbers. I did mention Caro is not applicable for consolidated financial statements. But if there are qualifications in the Caro reports of components like subsidiaries, associates, and the paragraph number with the details you have to give as a separate item in the CFS auditor's report. So that we have finished all the new clauses. Now other modified clauses we'll see if time permits. Retained clauses also we have already discussed in that 3-column presentation which I had done. But we can surely discuss if time permits. But a few things which we should be aware of is that I did mention the cash flow statements are also made mandatory for other than small companies, OPCs and dormant companies. All the companies have to prepare cash flow statements, because definition under 2 subsection 40 includes cash flow statements also. Now, what is a small company? The small company definition under 285 has also undergone a change. Not very recently, but many of us have not noticed. So it says that a small company means a private limited company whose paid up capital does not exceed 2 crores. It was 50 lakhs earlier. And I repeat, and the turnover as per the latest audit accounts does not exceed 20 crores, which was 2 crores earlier. The emphasis is on and. So to be a small company, you should cumulatively satisfy both the conditions. Your paid up capital should not exceed 50 lakhs. No, sorry, paid up capital should not exceed 2 crores. turnover, and turnover should not exceed 20 crores. So you may not have a turnover, but you have the paid up capital, which is 60 lakhs, for example. Then it's not a small company. That's how it will happen. So that's how it is. And if that happens, then the auditor in the auditor's report should report on the cash flow statements as well. Depreciation, I think we are used to. I don't have to explain this. Gone are the days of arbitrary rates as in the older schedule 14. We have schedule 2, which gives the useful life of assets. Residual value is arbitrarily fixed at 5%. And for intangible assets, the principles under AS 26 will apply. That's for amortization, not strictly depreciation, which is the cardinal principle of amortization under AS 26 is the useful life of an asset, it is assumed that will not, of an intangible, will not exceed 10 years. It is only an assumption, and that is being accepted. But if it's computer software, web design charges, etc., it is 5 years and not 10 years. They have to be written off for a period of 5 years. The term they have used is there is a rebuttable presumption that the useful life of an intangible will not exceed 10 years. So accounting standards. I make a back reference to what I mentioned in the first part of my presentation. Is there, we're talking about professional pronouncements in the second slide. To be precisely there, we did mention the professional pronouncements issued by the Institute of Chartered Accountants of India. They're issued by the Institute of Chartered Accountants of India, but accounting standards are today mandatory under 133 of the Companies Act. Government has notified all the standards issued by ICAI to be mandatory for all kinds of companies. There is accounting standards rules. So small and medium company concept is also there. That we will discuss, time permits. So accounting standards will apply. And in the main body of the auditor's report, not in CARO, in the main body of the auditor's report, the company auditor has to state whether the financial statements on which he is reporting comply with accounting standards referred to in section 133 of the Act. The level of awareness essentially has to improve, and the application also should improve. So all accounting standards, I put a question mark, will apply. I had a SICASA program at Ernakulam 3 days back, and very interactive session. We went for 3 hours. We had a capacity crowd here, about close to 200 students attended the program from various offices. So the question mark was for the students. I think for members also the question mark is relevant. The question is, how many accounting standards are there now? So let us save time. We have 27 standards as of now, but it's better to say that we have 29 minus 2 standards as on date. Accounting standard 1 is disclosure of accounting policies, and the last standard is contingencies and provisions, contingent liabilities, and contingent assets. In between the 2 standards which have been withdrawn. AS 8 on research and development has been withdrawn long back. I think it was withdrawn as early as 2003, and it is merged with the AS 26. R&D expenditure on the treat now we find it in AS 26. Okay, AS 8 was gone. But then we continue to have the standard accounting standard 6 on depreciation. In IFRS and Ind AS, there is no separate standard on depreciation. Depreciation is always blended with the standard on property, plant, and equipment, PPE. Like we have AS 26, which talks about recognition, measurement, presentation, disclosure, amortization of intangibles, AS 26. And the AS 10, property, plant, and equipment, they have replanted this accounting standard 6 with some modifications into AS 10, property, plant, and equipment. So please refer anything relating to depreciation or accounting standards, please refer paragraph 40 to 60 of PPE, accounting standard 10, property, plant, and equipment. So in the result, 29 minus 2, we have 27 standards. But level of compliance in many cases is very poor. Notes on accounts, still a sketchy one-pager. It cannot happen. Detailed notes of accounts have to be given. explanatory information, they call it. In IFRS terminology, they call it explanatory information. You have to write stories about what is there in the financial statements. Of course, this has given rise to a problem. The layman is not able to understand. Forget the layman, the chartered accountants, many of them, we are finding it difficult to understand. The experts like Y.H. Malegam once said, with all these technical standards, financial statements would have become more perfect, but they have become much less readable. Would have become technically perfect, but much less readable. But that doesn't matter. He can make a statement, but the regulator wants it that way. So we have no escape. We have no leeway there. So your special attention is invited to Accounting Standard 15, which is employee benefits. I've seen many cases where more than 100 employees are there. The company is 20 years old. The note on gratuity is not only gratuity, leave encashment. That is not discussed at all. Gratuity is accounted on cash basis. In another case, I've seen that gratuity is accounted under pay-as-you-go method. The pay-as-you-go method is pay-as-you-go is a layman's term. And when you add method to that, that sounds technically correct, but it's not. There's nothing like pay-as-you-go. It is cash basis. But the gratuity cannot be cash basis. You can do that, but the auditor will have to qualify. What I'm trying to say is AS 15, actuarial valuation is mandatory. Companies, all companies it will apply. Non-corporate entities, there is a level 1, level 2, level 3 differentiations there. In the case of companies, for all companies is applicable. Even if a company has only, let's say, 30 employees, Payment of Gratuity Act is not applicable. Even then, AS 15 says that actuarial valuation is mandatory. Elena, we have to qualify in the auditor's report and put a proper note in the notes on accounts. So AS 15, please keep it in mind that actuarial valuation is mandatory and we have to make provision for gratuity year after year. Incremental liability adjusted for payments which have been made due to superannuation, death, etc. AS 16, borrowing costs. Now, what's the treatment of borrowing costs? A trading company taking a working capital loan, a CC of 5 crores, and let's say at 12%, the annual interest is 60 lakhs. The entire thing is expensed. But this company wants to construct a factory and do backward integration. And therefore, they would say that, okay, we are buying land and we're constructing a building, a 10,000 square feet building, and for that taking a loan from the bank. From the time the building work is started until it is ready for commercial operation, the interest relating to that period should be capitalized. The specific loan for a specific asset. And once the building is ready for capitalization, though the loan may be paid over the next 7 years, 8 years, the further interest falling after the date of commercial production or commercial use getting started has to be expensed. There can be a situation where there are mixed borrowings and multiple assets, qualifying assets they call it. If an asset is taking more than 12 months for completion, it becomes a qualifying asset. An outlay on the qualifying asset, based on that, multiple borrowings are there. We arrive at a capitalization rate. Based on that, we add the interest to the assets, and then finally that interest also gets capitalized. Once a commercial operation starts, the entire interest is getting expensed. That is the spirit of AS 20, AS 16. AS 18 is a simple standard, related party transactions. A small privately limited company giving a remuneration of, let's say, 2 lakhs to its director. That's also a related party transaction requiring disclosure in the notes of accounts. AS 22, deferred taxes. Sir, the concept of deferred taxation emerged in 2006. Even now, many of the members are not fully aware, and the level of application is also poor. We have to essentially familiarize with AS 22 and recognize deferred tax assets and DTL liabilities wherever they are applicable. 26 is intangible assets. Does not recognize preliminary expenses, etc. as assets. So the cardinal principle is preliminary expenses have to be written off in the year in which they are incurred. Your 35-day treatment is completely different. It's a tax treatment. Accounting treatment is preliminary expenses will not result in an asset. There to be expense written off in the P&L. Special care I mentioned. There are many other standards which have to be given due attention to. AS 20, earnings per share we have to disclose. 13 investments, the current non-current distinction, etc., etc. All those things are there. So one has to be very quite aware of the accounting standards and do apply that in the preparation of financial statements, because a corporate accountant sitting here has a responsibility, it is binding on him, and the auditor sitting in the other side of the table should also has a responsibility reporting whether all these applicable standards have duly been completed. Sir, auditing standards. We have another 5 minutes to go. Auditing standards have been made mandatory under 143. Let me reiterate. Wherever I interact with the members, online, physical, during our sideline discussions, everywhere we discuss, people are not at all bothered about standards only. Till 2013 Act came, it was only a dictum of the institute on the membership. But today, let's understand that it's part of the statute. 143(9) says, every auditor, I repeat, every auditor, not every company, not every director of a company, every auditor shall comply with auditing standards. Are we doing it? What's the level of awareness and application? And in a disciplinary proceeding, the simple question, very impersonally they will ask, sir, I'm a senior auditor. I have 30 years of experience. I've introduced, Venkatesh sir introduced me saying 30 years of experience. Earlier we said 30 years as senior auditor. Now when I have 30 years of, I'm saying that I'm still young. But I can also say that, sir, I have 30 years of experience. And this client is with me for 20 years. Accountant on the romba therinju paya. So that, with that, I trusted him. This doesn't sell in a disciplinary proceeding. They're very impersonal. Who asked you to rely on this guy? He may be a non-person. It doesn't really work out. So, madam has started traveling. Nice to see you in a car. You're driving? Okay. So, let us ensure compliance. I'll give a few examples. So, 210, SA 210, terms of engagement. Major audits, first-time audits particularly, LOE, we call it LOE, letter of engagement. Kandipa, we should get it signed by the management. SA 220 talks about quality control of audit work. There's SQC standard 1. But quality control for audit work, it talks about processes and people. Very important. Having a policy, quality policy. QC policy of the firm. 230 documentation. Very little documentation we do. I had recently circulated another mail as a word of caution. I don't think it came to Madurai. I think it confined to Kerala. Recently, there's a disciplinary case on a member who signed projected financial statements without verifying anything, without any documents. Signing of projected financial statements are prohibited. Signing of provisional financial statements are prohibited. What many of us are doing that, saying that prepare from the books of account. No, he has been held responsible. August 22 journal paragraph, other that case law details are. And he just relied based on a request given by her accountant, not even the client. The client's accountant requested, and the auditor gave projected financial statements with the signature. He was held responsible for professional misconduct. Negligence rather. SA 300 are audit planning for large audits at least. We should have audit program. A very, very important requirement which we have to follow. Audit planning memorandum. Formats are there for downloads. You can Google up and download. We recently, because of the lot of changes which have happened in Schedule 3 and CARO, we are partners here, 3 of us sat together, spent substantial amount of time and rehashed our audit program for 21-22. 315, knowledge of business and risk assessment, etc., understanding the entity. That's very, very important standard. 500, evidence. 501, it is talking about special considerations for selected items. One of the items there is that it's standard request, a mandatory standard by the institute, by the Companies Act. NFRA can catch us, request auditor to be physically present for stock verification. Or if you're not able to be physically present, there should be some methodology, video streaming of the stock verifications as things can happen. We did one for EY from Pune during the COVID time. A Kerala company stock verification had to be done. We were engaged by EY in consultation with the client, and they video streamed the entire this thing, and somebody was watching sitting in Pune. And drones have started doing that. I don't know how it is being done. But then in normal case, if there is a factory near you, deputy a senior assistant and make sure that stock verification actually happens. Stock is really there. 505, external confirmation, a very important standard. 510, I did mention in opening balances. 570 is going concern. We discussed a lot on the going concern during the COVID times. So probably we are out of the going concern worries, and slowly we are moving forward with the businesses improving in terms of volumes and better outlook. 580 is a very important standard I did mention earlier, written representations. Obtain management representation letter at a senior level. Jay Shilin sir was talking about accountant, FM or director of finance level. We should get all that written in the letter of representation. MRL, I'm sure I sent it to a mass entire South mass mail. It should be in your mailbox. Also check in spam. It would have come from my mail ID, Jomon George. So these standards should also be complied with. So accounting standards we did mention. So we started with an introduction. Then we moved on to discuss threadbare the changes in Schedule 3. The new clauses in new clauses in CARO 2020. And of course, the other points which are very important, cash flow statements. Cash flow statements, accounting standards, and now auditing standards. Moving on, we also should be aware of the reporting standards, SS 700, 705, and 706. In between, we have SS 701 also. Key audit matters, which is also important. That's applicable only for listed companies as of now. Other reporting requirements, I think we can quickly run through. Adverse remarks relating to maintenance of books of accounts. Auditors' observations on financial transactions that might adversely affect the functioning of the company. Impact of pending litigations on financial positions. Accounting standards of material foreseeable losses, particularly as envisaged in Accounting Standard 7 construction contracts. If there are positions on long-term contracts, including derivatives, whether the loss, recognized loss in advance has been booked, etc. Delay in transferring funds to IEPF. And of course, there is a reporting requirement, IFC reporting. The guidance note of the institute finally said that let us not get into all the internal financial controls. Let us talk about internal controls on financial reporting. ICOFR, they are called, the experts call it ICOFR, internal controls on financial reporting. This requirement has been relaxed now for small companies. All small companies, IFC reporting is not there. Companies with turnover of less than 50 crores and borrowing less than 25 crores are also exempt, provided they have filed the AOC 4 and MGT 7 up to date. They should be compliant, in which case they are also exempted from IFC reporting, meaning that the 3-4 extra pages of that report which we prepare on IFC, that can be avoided, that can be done away. That's not applicable for these companies. So, my dear colleagues, thank you for staying with me for such a long time. We still have 31 online, whether I don't know whether all of them are on the presentation or doing some work. But it doesn't matter. It has been good time, good full 2.5 hours, 2 hours. We had some technical hitches in between, but I think we could make up with the cable, network cable coming to my laptop, working on the Wi-Fi. So with that, I thank the organizers for this session, for having me for the Madurai program, virtually though. Let us continue to interact on matters of professional interest. Passing through changing times, challenging times, we have to refabricate, re-engineer, and look into the future, probably with a different perspective. You know, the cliche saying that thinking outside the box. Many of the youngsters have started forming fintech companies. Some of them are moving out from accounting audit practice I'll give my example. I stopped going for income tax representation more than 12 years now. It's a conscious decision. I have a partner who's doing it. I guide him, but then I moved on to business valuations, more of audit quality matters, project reports. That's quite rewarding. And just before we started the session, I got a call from Dubai, referred by a bank manager who knows us, and he wants to do a project report, which is highly lucrative. And the best part about that is you are not attaching your name to it. It's very highly lucrative. Project reports also cannot be signed for information. SIA 3400 talks about how we can attach our name to projected financial statements, etc. So with that, let us continue to work together, interact in the interest of the profession. My mobile number and my mail ID is there with the branch, or I can always share with you. If you have pen, you can write down CA Jomon K George, easy to remember. Chartered account CA Jomon K George, no gap in between, at gmail.com. I'd be only happy to reply to your queries online, offline, at whatever point of time. So, wish the branch this year, of course, semi-COVID year, but then slowly should move out, and the chairperson would do a lot of programs. Can do on residential also, so that I can come to Kodak and be with all of you. So thank you once again for the great time. Honored to be with you. Signing off with a big thank you to the participants as well, the TFS this evening. Thank you so much.
Sure, sir. Thank you very much for your wonderful presentation. A summary of entire corporate audit in just a couple of hours. Really a great session, sir. I request Venkateshwar to deliver a vote of thanks, please.
Pleasant evening to one and all. It's my privilege to offer vote of thanks on this occasion. On behalf of MBSIRC of ICAI, I extend a really sincere thanks to our speaker, CA Jomon George sir, past SIRC chairman, who spared his valuable time to address our member on Corporate Audit 2021-22. In spite of hectic schedule, very elaborate explanation on the above topic. Your session is wonderful, sir. Thank you, Jomon K. George, sir.
Thank you very much.
It gives us.
Thank you very much, sir.
Yeah, please continue, sir. I hope I'm not interrupted.
It gives us immense pleasure to thank all the past chairman, fellow members, women members, and junior members for being here and for their effective and lively interaction on the above subject. Thank you. I also thanks all Madurai branch managing committee members. Again, I thank you for being with us this evening. It's a great pleasure. Sir, thank you, speaker, sir.
Thank you so much. With your permission, I'll sign off now.
Okay, sir. Okay, sir.
Bye.
Bye, sir.
Good night. I think it's time to say good night.